Fed, your go-to place for everything exchange-traded funds. I'm Frank Holland in for Mr. Bob Pisani. Wall Street is climbing a wall of worry on top of mounting fears over runaway inflation and a dramatically more hawkish Fed. Geopolitical tensions are also adding just a brand new layer of macro uncertainty to the mix for the global markets. In a flight to safety, gold prices, they shot up to the highest levels we've seen since just before Thanksgiving, while crude prices are hovering right around 80-year highs. Commodity ETFs suffered net redemptions in 2021, but they've already racked up more than $6 billion in inflows this year. So how does this latest turmoil factor into the commodities equation? Joining us now is Tom Lydon, CEO of ETF Trends, along with John Davey, founder and CIO of Astoria Portfolio Advisors. Tom, we're going to kick it off with you. ETFs are still on pace to hit over $700 billion in 2022. Pretty tough to top that record year that we had just in 2021. But why do inflows into equity funds? Why do they still continue unabated despite all the uncertainty out there?
Well, you're right, Frank. It would be tough to beat that $1 trillion mark that we almost hit last year, but we're on pace for almost $500 billion a month. A couple changes, though. Inflation and the threat of rising interest rates have really scared off investors. When you look at the average financial advisor, and we're surveying them every week, they've had major construction changes in their portfolios. What they're doing is paring back the traditional 60-40 and moving more out of fixed income and into areas like alternative income strategies, like dividends or even options overlay strategies. And then most importantly, more and more advisors are allocating, as you say, to commodities. We're seeing commodities shoot up all over the place, and there's some great diversified commodity options that are there. Look, rising rates can be very, very detrimental to client portfolios. Advisors understand that. Investors haven't seen that in a long period of time, but they're voting with their feet.
Yeah, absolutely. John, over to you. How would you say that investors, how should they cope with all this elevated risk?
Well, I think, largely speaking, commodities make a lot of sense because they are hedged against inflation. We didn't have much inflation for the last 10 years. CPI is now 40-year highs. So tickers like PDBC, BCI, these are broad-based commodity ETFs that we utilize at Astoria Advisors. There's really three reasons why you want to own commodities. One, it's a hedge against inflation. So these tickers that I just mentioned, they're up 11% year to date. S&P's down 7%. Bonds are down 3%. So you see that right then and there that they're serving their place in the portfolio to provide inflation protection. But there's two other attributes. One is, when you have geopolitical risk and tension, you tend to see oil go up, you tend to see gold go up, and that's different from stocks, right? When stocks go down, and this year actually bonds have been going down. So the technical term is that they provide positive skewness. Stocks have negative skewness. So it's worth having in the portfolio just to diversify your risk attributes. And then the third reason, which is more unique, is that they actually provide right now a positive benefit. There's no cost to owning these commodities. And this has to do about how commodity futures roll. Right now, you're getting a benefit. Years in the past, they used to have a cost. So those three attributes, we like to have commodities in our portfolios at Astoria Advisors.